People ask me a version of this all the time. Bill, how much do I need to save to retire? My answer is always, it depends. It depends on a lot of things. Then they ask the follow up, okay, but what if I want to retire in 10 years? How much do I need to invest every month? That is a better question because now we have a timeline and a target. We can actually run numbers instead of just daydreaming. And it fits something I've said many times in different contexts. Most people overestimate what they can do in 1 year and underestimate what they can do in 10. 10 years is short enough to feel real, but long enough to completely change your financial life if you are intentional. I have been working almost my entire life. I started Microsoft in my early 20s. Today, I still work full time on global health, education, climate, and technology. I've even said publicly that full retirement actually sounds awful to me. I would rather keep working for the next 30 years. I like working. I like solving hard problems. I am the kind of person who would keep doing this even if there were no paycheck at the end of the month. So when I talk about retirement, I do not think only about stopping work. I think about freedom. Retirement, to me, is having enough money that you do not have to work if you do not want to. That is what we are really talking about. Today, I want to walk you through the math, the real math, not the fantasy where you magically retire on a beach at 40 with no plan. The actual numbers for someone who wants real financial independence in about 10 years. Let us start with the big question: how much do I need to retire? The real answer is it depends on how much you spend. Most people think about retirement backwards. They say, I need $1 million or I need 2 million. But that is not how the math works. The question is not how big does the pile have to be. The question is, how much do you spend every year? Your retirement number is based on your spending, not on a number you saw in a headline. There is a simple rule of thumb called the 4% rule. It came out of research that looked at many decades of stock and bond returns and asked, what withdrawal rate could a retiree use and usually be okay for about 30 years? The rough answer was about 4% a year. In simple terms, you can often withdraw about 4% of your portfolio per year and have a good chance of not running out of money over a 30-year retirement. It is not a guarantee, but it is a useful starting point. So if you spend $40,000 a year, you need about $1 million because 4% of 1 million is 40,000. If you spend 80,000 a year, you need about 2 million. If you spend 20,000 a year, you need about 500,000. Your spending sets your number. The 4% rule assumes you invest in a sensible mix of stocks and bonds and earn a reasonable average return over time. Historically, United States stocks have returned roughly 9 to 10% a year, including dividends, and something closer to 6 or so after inflation when you look across many decades. Bonds return less, but they smooth out the ride. The rule also assumes your retirement lasts about 30 years. Retire at 65, leave to 95, and 4% is a reasonable rule of thumb. If you retire earlier, the math changes. If you retire at 50, you might aim closer to 3.5%. At 40, maybe 3% or less. The earlier you retire, the longer the money has to last, so the more conservative you need to be. Now let us make this concrete. Suppose you want to spend $50,000 a year in retirement. That is a solid middle class lifestyle in many parts of the United States. Using the 4% rule, 50,000 divided by 0.04 gives you $1.25 million. So that is your target, 1.25 million. That is your retirement number. Now we can ask the real question. How do you get to 1.25 million in 10 years? To answer that, you need two key pieces of information: how much you already have saved and what kind of return you can reasonably expect on your investments. Let us talk about returns first. No one can predict the future, not even someone who had a front row seat to the personal computer revolution. But we can look at history. The main index people watch in the United States, the S&P 500, has delivered around 9 to 10% average annual returns with dividends over long stretches and roughly 6 to 7% after inflation. Some years it is up a lot, some years it is down a lot, but that is the long-term pattern. For planning, we will use 10% before inflation. That is optimistic, but if you are mostly in stocks, it is a reasonable working assumption. Now, some scenarios. Scenario 1, you are starting from zero, nothing saved yet. To reach $1.25 million in 10 years with 10% returns, you would need to invest roughly $6,500 per month. That is about $78,000 per year. That is a lot. Most people cannot do that unless they earn a high income and choose to live far below their means. Niyam 2, you already have $100,000 saved. Now you do not need the full 1.25 million from new contributions because your existing 100,000 will grow over 10 years at 10%. It could more than double. With that head start, you might need to invest around $5,000 a month, about $60,000 a year. Still aggressive, but more realistic for some people. Scenario 3, you have $250,000 already saved. At 10% per year, 250,000 can grow on its own to roughly 650,000 after 10 years. That means your new contributions only need to fill the remaining 600,000. To do that, you would need around $3,000 a month or 36,000 a year. That is still serious, but it now feels possible for many disciplined households. The pattern is clear. The more you already have, the less you need to invest every month. That is why starting early is such a huge advantage. When I was building Microsoft, I was obsessed with having a big safety cushion. We kept enough cash to cover about a year of payroll because I wanted to be sure that a downturn would not kill the company. I have summed that mindset up this way: save like a pessimist and invest like an optimist. You assume there will be storms, but you still believe in the future. The same idea applies to your personal finances. You want a strong margin of safety and time for compounding to work for you, not against you. If you start at 25 or 30, compounding can do an enormous amount of the work. If you wait until 40 and start from zero, the math becomes unforgiving. We also have to be honest about that 10% assumption. Some decades are great, some are disappointing. Sometimes you get a long bull market, sometimes you live through sharp crashes and flat periods. If you happen to retire right after one of those bad stretches, that is dangerous because you will be withdrawing from a portfolio that has just been hit. That is sequence of returns risk. How do you handle that? You build in a margin of safety. You plan for lower returns, maybe 7 or 8% instead of 10. You save more than the bare minimum. You stay flexible. If the market crashes right when you plan to retire, you accept that you might work another year or two or cut spending for a while. Rigid plans break, flexible plans bend and survive. Now let us flip to the other side of the equation: spending. The less you spend, the less you need to save, and the easier it is to retire early. If you can live on 30,000 a year instead of 50,000, your target drops from 1.25 million to 750,000. That is a $500,000 difference. If you can live on 20,000 a year, your target is 500,000. You might say, "Bill, I cannot live on 20,000 a year." And maybe you cannot, given your family and where you live, but many people can live on much less than they think if they are strategic. They move to a lower cost area. They avoid constant lifestyle upgrade. They stay out of expensive debt. They keep housing and transportation modest. Early in my life, even when Microsoft started to become successful, I was not chasing a fancy lifestyle. I worked long hours, ate simple food, and focused almost everything on building the company. I did not start with private jets and mansions. The habit of being intentional with spending is more powerful than most people realize broadly. There are two ways to retire early. You can earn more and save more, or you can spend less and need less. Most people focus on the first one: I need a higher salary. The second one is often more powerful. If you cut your spending by 20%, you need 20% less in your retirement portfolio, and you also free up 20% more cash to invest today. That is a double benefit: lower target and higher savings. That is the magic of living below your means. Let me give you one aggressive example. You are 35, you make $80,000 a year, and you are very serious about retiring at 45. Suppose you get your annual spending down to $30,000. That means you are saving 50,000 a year on an 80,000 income. That is a 62% savings rate. Extreme, yes, but there are people who do this. If you adopt that lifestyle and plan to live on 30,000 a year in retirement, the 4% rule says you need 750,000 because 4% of 750,000 is 30,000. Can you get to 750,000 in 10 years if you invest 50,000 every year and average around 10% returns? The math says you end up around 800,000. That is enough. In theory, you could retire at 45. I would not recommend this path to everyone. It assumes strong returns, no major crises, and a very lean lifestyle, but it shows what is possible when high savings and disciplined investing work together. Now, let us add something people often forget. Social Security, or whatever your country's basic pension system is in the United States, Social Security will not make you rich, but it matters. The average monthly check for retired workers is somewhere around a couple $1,000 in our simple numbers. Think of a benefit of about $1,800 a month, roughly $21,000 a year. If you retire early, you will not see Social Security for a while. But once you reach your early 60s, that income starts and it changes the math. Instead of needing 50,000 a year from your portfolio, maybe you only need 29,000 because Social Security covers the rest. Now your required portfolio shrinks from 1.25 million to something in the 700,000 range. That is a big difference. It turns some early retirement plans from impossible into difficult but achievable. When I think about building financial security, I see three layers. Layer one is your guaranteed or semi guaranteed income, like Social Security or a pension. That is your base. Layer two is your portfolio, your savings, your 401k, your individual retirement accounts, your brokerage accounts. Layer three is flexibility, your willingness to work part time if needed, to adjust spending when markets are bad, to delay big purchases, maybe even to move somewhere cheaper. Flexibility is a form of wealth. It protects you when reality does not match your speculum. Now, let us talk briefly about where you actually put your money. Saving is not enough. Leaving your money in cash while inflation quietly erodes, it is not a plan over the long term. Stocks have beaten bonds and cash. That is why, for my own investments outside Microsoft and the foundation, I set up a firm called Cascade Investment to build a diversified long term portfolio in many different industries. I did not want everything in one company forever. I wanted broad, steady compounding in businesses with real cash flows. You do not need your own investment company, but you can use the same principles. Diversify, think long term, avoid unnecessary fees, do not chase the latest fad. If you are trying to build a big portfolio in just 10 years, you probably need a lot of stock exposure. Bonds at 4 or 5% will not get you there unless your savings rate is enormous. If you are knowledgeable and enjoy it, you can pick individual stocks and build a portfolio of great companies. But most people do not have the time or the interest to study financial statements. That is what index funds are for. An SP 500 index fund simply buys the big United States companies for you. You get diversification, low fees, and those long term market returns we have been talking about. If I were starting from scratch and wanted to retire in 10 to 20 years, I would open a retirement account, a 401k at work if I had one, an individual retirement account if I did not. Then I would set up automatic monthly contributions into a low cost SP 500 index fund or a similar broad market index. I would pick the amount based on the math, 2000 a month, 3000, 5000, whatever the gap and the timeline require, and then I would stick to it every month. Bull market, bear market, sideways market, it does not matter. Just keep buying. That is dollar cost averaging over time. You buy more shares when prices are low, fewer when they are high, and you avoid the trap of trying to guess the perfect moment. Believe me, even professional investors get that timing wrong a lot. Now, taxes. If you invest in a regular taxable account, you pay taxes each year on dividends and realized gains. That slows down your compounding in a 401k or traditional individual retirement account. Your money grows without current taxes. You do not pay until you withdraw in retirement. That difference can easily add six figures to a 10 or 20-year plan. So max out tax advantaged accounts if you can, especially any 401k match. That match is one of the easiest ways to boost your long-term results. Now back to something people worry about a lot, market crashes. What if we get a big drop when I'm halfway to my goal? Crashes and corrections are normal. If you're still saving and investing, a 30 or 40% drop is emotionally painful, but financially it is a sale. You're buying the same companies at cheaper prices. As long as you keep investing, the crash can actually help your long term results. If you are close to retirement, a big crash is more dangerous. You're about to move from putting money in to taking money out. That is why, as your target date gets closer, you gradually shift some of your portfolio into bonds or cash like assets. If a crash hits right as you retire, you can live off that safer portion for a while and let your stocks recover. That is how you manage sequence of returns risk in practice. There is another big factor people underestimate: healthcare. If you retire early before your country's public health system fully covers you, you have a gap in the United States. Medicaid starts at 65. Before that, insurance for a couple can easily be $1,000 to $2,000 a month, 12,000 to 24,000 a year. If you planned on spending 50,000 a year and then realize healthcare adds another 20,000, suddenly you need 70,000 a year at a 4% withdrawal rate. That pushes your target portfolio from 1.25 million to 1.75 million. That is a huge difference. You have to include healthcare, taxes, insurance, and a buffer for emergencies in your plan. Roofs leak, cars break, people get sick. Life does not care about your spell. That is why I keep emphasizing margin of safety. Be conservative. Save more than you think you need. Spend less than you think you can. Save like a pessimist and invest like an optimist. Prepare for storms, but still believe in the future. Let me give you one story to make this real. A friend of mine retired at 55. He saved aggressively, invested in index funds, and built a $1 million portfolio. He calculated that he needed 40,000 a year, and 4% of 1 million is 40,000, so he thought, I am fine. For the first few years, the plan worked. The market was up, his portfolio even grew while he was withdrawing. Then a bad year hit. The market dropped and his balance fell to roughly 750,000. He was still pulling out 40,000 a year, but now that was more than 5% of his balance. At that rate, if markets did not rebound quickly, the risk of running out of money went up a lot. So he went back to work part-time doing consulting. It was not a tragedy, but it was not what he had pictured. If he had built a bigger cushion or waited a few more years, that step might not have been necessary. That is the difference between a plan that works on paper and a plan that is robust in the real world. So, what do I actually recommend if you want to retire in 10 years first? Figure out your real spending, track it for a few months, look at every dollar, then multiply that annual spending by 25. That is your approximate retirement number using the 4% rule. If you spend 50,000 a year, that is 1.25 million. Next, look at what you already have invested and estimate what that will grow to in 10 years at a conservative return, maybe 7 or 8% instead of 10. Find the gap between what you are on track to have and what you need. Divide that gap by 120, the number of months in 10 years. That monthly number is what you need to invest. If it is impossible, you have three levers: work longer than 10 years, spend less in retirement, and now earn more today so you can save more. Those levers are not glamorous, but they are real. Retirement planning is not magic, it is math. Simple math, but honest math. A lot of people do not want the honest math. They want to believe they can retire on far less than they truly need, that markets will always cooperate, that healthcare and emergencies will not show up. That is not planning, that is hope. Real planning is conservative. It assumes things go wrong and it builds in room for those problems. We also have to talk about the psychology side. Money is half of retirement, meaning is the other half. If you retire with plenty of money but no purpose, no structure, no sense of contribution, you can still be miserable. So before you retire, think deeply about what you are retiring to. Will you volunteer? Start a small business? Mentor young people, learn new skills, travel, create things, spend more time on causes you care about? You need something that gets you out of bed in the morning. One reason I have never fully retired is that I love what I do. I love building Microsoft. I love working on global health, on vaccines, on climate and education through the foundation. I like working with smart, committed people. I have more money than I will ever spend. I do not work for money anymore. I work because solving hard problems gives my life meaning. I have also committed to give away virtually all my wealth in the coming decades. That should tell you something. Money is a tool, not the point of life. It can buy security, freedom, and the ability to help others, but it is not the purpose by itself. If you stop thinking only about escaping work and instead move toward work you actually like, even if it pays a bit less, you may be happier before and after retirement. Financial independence should feel like freedom and choice, not a prison sentence with a countdown clock. So let us finally answer the question again. How much do you need to invest every month to retire in 10 years? It depends on how much you already have, what you spend, and what returns you get. But using these examples, if you are starting from zero and want to spend 50,000 a year, you probably need to invest somewhere between $5,000 and $7,000 a month for 10 years. If you already have 100,000 or 200,000, that number might fall to 3,000 to 4,000 a month. If you can live on 30,000 or 40,000 instead of 50,000, maybe 2,000 to 3,000 a month gets you there. The key word is Flexibility. If you insist on retiring in exactly 10 years with a fixed lifestyle and no willingness to adjust, you are building a fragile plan. If you say, I would like to retire in 10 years, but I am willing to adapt based on how things actually unfold, your odds improve dramatically. Maybe markets are strong and you hit your target in 9 years. Maybe there's a big crash and you push it to year 12. Either way, you are okay because you are flexible. So here's my challenge to you today, not someday. Figure out your real yearly spending, multiply it by 25. That is your target. Look at what you have already saved. Estimate what it can become, find the gap, and calculate your monthly number. If the number scares you, do not just close the app and forget it. Adjust your life, spend less, look for ways to earn more, be open to a longer timeline, but act because every month you wait is a month you lose. Every dollar you invest early is a little worker that compounds for you for years or even decades. If this helped you think more clearly about your future, do not just scroll away, share it with someone who needs this wake up call. Hit subscribe or follow whatever button is in front of you so you do not lose track of this journey. And then, more importantly than any button, open a notebook or a spell tonight and run your own numbers. Your future self will thank you for starting today.